Welcome to the Dividend Talk podcast, episode 222. What to do after a 20% price drop. Dividend Talk is your number one podcast for all things dividend and stock market related with a unique European flavour. My name is Derek from Engineer My Freedom and I'm joined with my co-host European DGI. If you want to learn more about us, please visit europeandgi.com where we have articles on dividend growth investing, including 30 European dividend aristocrats. While you're there, you might as well grab our free dividend portfolio tracker template. We also offer a premium dividend growth service featuring a bi-weekly newsletter which includes stock deep dives, dividend stock cards, and access to our dashboard with over 130 dividend growth stocks. All of this is based on our very own dividend safety analysis. But enough about that. Please grab a cup of coffee and let's get started. Hey, European DJ, you know I hate asking this question, but it's not for me this time. Pete Lee wants to know, how are you doing and whether you had a busy week or not?
I'm a bit wasted after a week. It was very busy. Work was good. It was very productive, but it was a very busy week. I must confess, like always. It's this time of the life. From that point of view, financial independence is, I just hope that I stay healthy all those years. But financial independence is coming around the corner, and then the question is like, will it be retire early? Yeah.
What to do?
And we got a nice email the other day from Ron Pieser saying, really like, okay, why? Yeah, why not just retire? So that's a good question. That's a good question.
Valid question. And credit to Pete as well. He actually reached out to Sven Carling again to put pressure on him to come on this podcast. Sven's reply was something in and around, it takes time to get him on a podcast, but come on, Sven, it's been 3 years. It doesn't take that much time. So it's quite interesting. I'd love to get him on the podcast. I think it would be pretty epic. But let's see. Let's keep putting pressure on him. He'll come on eventually. I've no doubt. But look, enough about how you've been. Enough about your work week. What about the news of the week? And we can't escape Target. They had a 20% price drop. Probably inspired us a little bit to do this show. We got a question around this as well. But what do you make of it?
Oh, actually, I didn't really have time to go deep into it as such, but I did buy some. That's a good thing. I saw mostly on the high level numbers when I scanned to it, like, okay, there's some more overhead. It's pressuring the earnings. When you purely look at the financial statements, right? Cash flow, they've been building up inventory. So because there was a cash flow outflow on that, so they're probably getting ready for the holidays. If you also compare it with last year, it was similar trend. Now it was just a bit more, maybe due to cost inflation. So all in all, I think they are just struggling a little bit with a higher cost basis, but revenue was growing slightly. So I really think like the margin therefore is under pressure, and that's why it's setting the stock down. I did read in the press release that they lowered their guidance by 70 cents, which is about 5 to 8%, let's say, compared to their former guidance. So to then drop of 20% for me sounds a bit tough. I did saw on social media some people kind of coming with the target is just have no right to exist kind of narrative, and it feels like Walgreens. And I'm definitely not of that camp. I just know that this is more of a cyclical chain because of the the stuff they sell, what I always understood. Yeah, so it's not just purely groceries. A lot of their sales comes from merchandise. You can imagine if there's how is it, a weak consumer, they focus on food first, and we know this. Yeah, I did 2 years ago. I really went deep into Target to understand this business, and I just saw like this one of the most cyclical companies out of this whole cohort due to their sales mix. So this was a bit to be expected at some time. It has therefore, I think, more often those fluctuations of 20% up, 15%, 20% down, 10, 15% up. It's a bit of the nature of this business, and you need to have a stomach for it.
Yeah. I think the majority of the consumer sentiment around this was because Amazon and Walmart did quite well, and we spoke about a weak consumer, and they look at groceries first, and groceries are around 23% of Target's offering, so it's not enough to take away the impact of this. So with them having such good quarters and then Target having to lower their guidance, the market is now spooked and Target is now dead, and that's it. But yeah, I think if you look purely at the numbers, yes, they missed guidance. Yes, sales was down slightly this quarter based on last quarter, but it's up year on year, I believe. So it's all not as bad as it seems in my opinion, and it made for a good buying opportunity, I think, especially if they were on your watch list.
Yeah. So I did buy something. Yeah, it's as simple as that. Look, if you zoom out, right, the company has, based on their outlook, a 54% payout ratio. That's what we're talking about here. Based on the lowest end of the forward guidance, it will still have a 14.7 price to earnings. The question then is like, do you think like it will now go off a cliff and every year, like for the next 3-4 years, come to go almost to zero? Who knows? But I'm not in that camp.
Me either.
You know, we can't predict the future, but I've seen too often with these, and actually since I own some Target, that this is kind of how this business operates. So yeah.
Nice. That was all pretty much in the news from me this week. We couldn't really ignore it. In terms of dividend hikes, it's been quite in that front as well. Two that I noted were McCormick's, which is an American food and spice company. I think they have 37, 38 years of dividend hikes, and they had a nice dividend increase of 7%, which is pretty cool. And Merck and Company increased its dividend for its 13th or 14th year by 5.2% to 77 cents. So there we had it. So we'll move on to the main topic, which is centered around this 20% price drop. We've already spoke a little bit about Target, but MMAC has asked us a lot of volatility in recent months and decent companies. So Starbucks, Nike, even AbbVie that has escaped me, and Target have seen drops of around 20% in a single day. So the question is, do you have a strategy for these type of situations? So the first question I'd ask is, why did companies drop this much in a single day? And how do you tell if it is an overreaction or not?
So why? I mean, the why that would be saying that I have a deep understanding of every stock and what every investor or trader, whoever this thinks of this stock. Yeah. What you do tend to see is that there's increased volatility when the market is a bit more nervous. There's a lot going on. New president in the US. The dollar went to $1.04 compared to the euro. Well, it was mostly around 110 over the last few months. Yeah. We have lots of news everywhere about weaker consumers, industrials. We have also Russia tension just growing now with what's happening as again with the long distance rockets and everything. So I just feel like the market generally is more nervous, and therefore I think like companies are punished much harder at this moment in time. That's a feeling that I have, because if you look at the guidance decline the Target was offering, in my opinion, it doesn't justify 20%. Yeah. So the question then is, and that's how I look at it, but I'm interested in you as well, is like, is this a falling knife?
Yeah. Yeah, and that's I suppose that's the hardest question to answer. How do you know, is it a falling knife like Walgreens, for example, that dropped 20% and kept dropping, and VFC was another one, if I remember.
Yeah.
Versus, I'm going to take Starbucks, that dropped 20%, but a couple of months, probably not even a couple of months later, increased by 20%, and has stayed on that
Because
trajectory.
those stocks are mostly like Starbucks is mostly based on the narrative where it trades. Yeah, so the Starbucks is dead, the coffee is too expensive narrative versus the new CEO comes in, wants to go back to the core. So it's a lot about the narrative. Because if you look at the earnings, they're kind of stable, but they started flattening, yeah, with Starbucks. So then if you look at Target, yeah, what's it here? I think here it's more like the earnings. So really the earnings, not so much the narrative. Target doesn't have that narrative, but the narrative around it, maybe indeed Walmart's and Amazon, right? Who are they eating Target's lunch? And I think you need to get a really good view on the narrative to understand, like, okay, is this something temporarily? Is it even justified?
Yeah.
Or is there a fundamental thing wrong in the business? So I never invested in Walgreens and CVS because I don't understand how this whole drugstore chain stuff operates in America. So with all this real estate and everything, because we don't know this in Europe, so I found it hard to understand. But I was not able to judge on the business model itself of Walgreens and CVS. It was just purely the fact that I don't have a feeling for their business. And this comes to, like, you need to have a conviction, you need to know what you own. Yeah. So, and this is also important here. If you know what you own, it's much more easier to go through these times. Of course, when any stock drops 20%, I would always check. Yeah, this is not something that you just say, like, okay, next move on, because 20% drops don't happen a lot. Yeah, this means generally a really big event for the stocks that we typically invest in. Yeah, so you need to look into it, and then you need to ask yourself, like, hey, is there something fundamentally wrong here? Did something fundamentally change? I didn't see it when I briefly watched over the financial statements. I see inventory building at a higher cost because of inflation. I see higher overhead cost in the company because that's what sales and general expenses are. Maybe they've been investing more in IT. I would need to really go into the details to understand that here. But the balance sheet doesn't tell me how much compared to how much the market is spooked by this.
And is that the difference then? So we're comparing this to, say, Walgreens, which might not be a fair comparison, but these are all global brands. So we look at Nike, Starbucks, and Target, which are the three that we speak about a lot and have seen this type of drop. We probably understand these a little bit better because they're global. They're not just Americanized, whereas Walgreens is America. It's Americanized. So it's hard for us to get a sense of what the narrative is around Walgreens. And I remember I spoke to you when I visited my sister in the States. There was a lot of negativity around Rite Aid that we just were not aware of. And the hate towards it from Americans was quite substantial. So we never got that feeling. Whereas with Nike, Starbucks, and maybe not so much Target, but definitely Nike and Starbucks are globalized. So it's easier to get a sense of what that narrative is. But then if we compare that to Target, maybe we don't get the same feeling over here as the Americans do. And we might compare that to Walgreens.
Yeah. Well, there's still something else, right? There was one time, and I forgot who it was, on Facebook, and the person commented, like, don't borrow, you can't borrow conviction. And he said, like, it's a bit hard on single individual stocks because there's always like this information kind of delay that you have. But I do have a lot of conviction in my portfolio. I think that's what the person said, because out of all those holdings that I have, these are just really high quality holdings. And, you know, if one or two go bad, then so be it. I think that was kind of a little bit what the person tried to say. And that's kind of on the first level how I think about it. In my portfolio, you know, for me, Target, I feel very comfortable with. It's a small position. I doubled down on it with this drop, so it became a bit of a larger position. But it's no way as clear, as close to Shell and Microsoft that I have a much deeper understanding of. But then again, I think like when it comes to Amazon and Walmart, I just remember, and if I look at back my notes and everything that I made at the time I made a video about it, this business is just more cyclical, so it's not a surprise for me. Yeah.
Yeah.
And then if I see what the drop is, it feels like an overreaction for me. So for me, then I think like I can get this stock at 3.7%
Yeah.
dividend. When did that happen over the last year? So and I had the same with Ahold when and back in 2016 or 2017, like Amazon bought Whole Foods, and suddenly all the grocery chains in the US would be wiped out.
Yeah.
Yeah. So that's when I loaded up.
So when you're going to buy Target, then so the drop happens, what's your thought process here? I know you own a small bit.
My thought process is like don't buy too much too fast,
Okay.
because this is where the theory of the falling knife comes from.
Yeah.
It's better to let the knife fall and hit the ground, and you know that it's hitting the ground because of the ripples, which means like wait a week or two and you see it recovering slowly again. Yeah, that's typically when you're dealing how you can deal best with a falling knife. Now it was just more in buying in the excitement. Yeah, because for me that was what this was about. So you buy a few shares and then now I don't touch it. Maybe in 2 months again, because I've also seen that some stocks, they tend to do a 10-15% drop every 3 months after
Yeah.
every earnings. So I would not average into such a position within 3 months. With this one, you want to see a few quarters generally to really spot a trend. And yeah, that's how I look at that from that point of view. How
Yeah.
about you?
Yeah, I'm the same. Like with companies that I already own, if they drop 20% and I have conviction in them, no problem adding more. But I think that's the key part to me is you need to have your work done beforehand and not making a decision on buying or selling in that moment based on the share price, which is very, very hard. I mean, I quickly looked up Reddit before we came on this just to see what it was saying about it, and every comment was Target is dead. It's for that more affluent consumers that want to go there. Walmart have better products, Amazon have better products, and if you were to make a decision based off sentiment and what you read, you would sell
But this
straight
is
away.
often the case. The
Yeah,
sentiment was also a Starbucks at 70. The sentiment is like it tastes worse than pee, yeah, or sewer water, whatever it is called. Like, look, I think about differently. Target is doing better than 5 years ago, and it's trading now at the price of 5 years ago. In the meanwhile, it went all the way up to 260 in the aftermath of COVID. So I never bought at those prices. So I'm very, very comfortable with this price setting.
yeah. And then you never considered selling Target or Starbucks. Why was that?
No,
Just
these are
confidence?
these are good businesses, and you need to know that, like life, nothing goes up in a straight line. Yeah, it's simple like that. So if you believe that this company will be better off 10 years from now, have okay-ish or good enough management, then why bother? What I did in the past, I invested more in turnarounds. That's where my mistakes were. I listened sometimes too much to CEOs and not verify the numbers. Yeah, that's why I made mistakes in General Electric and Tupperware. But most of these kinds of investments have done me well over the years. Yeah,
Yeah,
so fraud or settlements like or legal actions like Bayer, those things have hurt me. These situations have never really hurt me.
yeah.
Like, like even T. Rowe Price, it has gone nowhere. Yeah, over those 2-3 years, but it's one of the only stocks in my portfolio. I still would argue it's trading at a value. It's just trying to figure out how to get its assets under management to grow again. I don't know. I think it is important for people to just stay calm, look at it more objectively. What means more objectively for me? It means more like follow your process, the process that you always follow. In my case, the 3 financial statements, getting an understanding of its value. So what is it priced at today? And then thinking about the current cash flow or net income, and what kind of growth is anticipated in that. And you can do this by using discounted cash flow or dividend discount models, you get a feeling of how much growth is priced in based on the current numbers.
Yeah.
And maybe just to mention to the investors, generally speaking, the market is still expecting this company to grow. Yeah, otherwise the price would be going to zero already. Yeah.
Yeah.
I know it was a 20% drop, but it would have dropped much farther if they thought the company was dead. Yeah. So there's still growth expected in this company, but I guess some people are willing to pay less for it. Maybe they just had too high growth expectations for this company. Well, hey, good.
Yeah.
Sell me your shares, give it to me.
But then how do you stop yourself from getting swayed by this market noise?
But I have another issue, Derek. My
Yeah.
issue is that all those stocks that I would like to own, they are typically too expensive.
Yeah.
So now there is one time a discount. And what then?
And that's my point. And I'm taking. We only have to look back a few weeks ago. You look at Louis Vuitton, LVMH. We saw that the China narrative was hurting these guys. It rebounded slightly on the back of China announcing some stimulus. Everybody's like, I wish I bought more LVMH. I wish I did this. I wish I did that. It drops again because the China narrative is not as good as expected. And now everybody is saying, I'm not buying LVMH at these prices. It's overvalued. I mean, it seems that price action is determining what people do
what
or
the
don't
company
do.
should be doing.
Yes.
Yeah.
Yeah.
And I disagree with that.
Yeah. And how do you stay away from that noise? How do you block that out?
Well, I mean, you and I are quite long in this investing already, at least myself since 2014, and you just build a skin. You see patterns over time. You have seen ups and downs over time. But the only thing that went exponentially up is my portfolio and my dividend income. So I don't know. I guess I've been able to cancel out the noise mostly. And sometimes the market is right, most of the times not. And my investments do well. So, and those few times that the market was right and I wasn't right, yes, it impacted my performance, but not to an extent that it hurts me. Yeah, because all the others they overcompensate. There are stocks like Upvi. When I bought them at 67, do you really thought that I would see them tripling so fast? No, come on. There was a huge patent cliff with Humira at the time. Everyone said like this company has no existence ahead of it. Microsoft at 40. Yeah, when I was looking at that, Seeking Alpha. Oh, who invests in Microsoft? Microsoft is dead. It's an old company. Dinosaurs. Go with Apple. Yeah, well, Satya Nadella already was at the helm and already started to show that the cloud started to grow.
Yeah,
but there was this whole Microsoft narrative, like because they look at Windows and they think like everything in Microsoft sucks. There was the whole narrative at that time at 40. Now they're at 4. So did I think that it would be at 400 now at 10 times? No, I didn't. That's not what I modeled with. I modeled with probably with 7 or 8% growth, and I thought like, well, it's fine, nicely valued. It's just probably down 15 to 20% growth after that. So it goes both ways, right? Sometimes you underestimate, the other time you overestimate.
Yeah, it's quite fascinating. I find psychology of investing really, really fascinating, how people interact. But what I try and do, especially with these, and Target is one because they were on my watch list, and then you see a 20% drop, and the first thing I do is I don't look at social media at all.
Me neither.
I just throw it away and I look at the numbers, and
exactly.
I make up my own mind. I write it down somewhere. I'll make up my own mind about what I think, and then I'll read everything else just to see if I've missed anything. But in that case, it will take a lot to sway my decision. Because I've already made up my own mind. That's how I try and handle that.
Yeah, but it has also sometimes prevented me to buy because, for instance, then you read the numbers. And then social media is like, you see it very fast dropping. And why? Because, for instance, in the transcript, you will find that the CEO mentioned something. Yeah, that, we're not going to invest in this.
Yeah,
I will remember the Ahold Belgium tax advantage. Yeah, that they had. It was not clear until the conference call, and then the stock started dropping. Right. So sometimes social media or just the news does help. But to your point, I think we need to first make up our own mind and then test it with the crowd a little bit. But I have conviction in my process. That's probably even better to say.
Yeah, and that comes with, in my opinion, experience and going through this situation once or twice, making a mistake, getting it wrong, and learning from that. I think that's for me, that's the best way to learn. And I've had enough turnarounds, Walgreens, Intel, AT&T to a certain extent, to realize I don't want those type of companies because they're falling. Their fundamentals are deteriorating versus Starbucks or Target. The fundamentals are not deteriorating. It's just sentiment is deteriorating. I think that's
well, but others would argue that these fundamentals are deteriorating, right? Because they look more at the business side of things, not necessarily yet at the earnings, and it may be a good indicator at times. But then again, we don't see it in the numbers, and I know it's cyclical. So based on that, I feel like, okay, thank you for the opportunity.
Yeah. Interesting. It's interesting, right? 20% drops. What you pray for this to happen, and when it happens, most people freeze. That's what I find.
Yeah, and let's be fair, right? It's still just a 3.7% company. We're now not talking about a 6 or 7% yielder. Yeah, so it's very interesting. I'm just happy that I was able to grow my investment a little bit in it. And it will never be a very big account. I've got much bigger bet on Ahold as an example, and Unilever and Danone. Those are much bigger for me. Well, Danone and Unilever didn't even do so well, but with Target, it's now nicely becoming a little bit more meaningful as a position. I'm happy with it, and I've been typically buying around this range, so I'm hardly in the minus.
Yeah. Nice one. Yeah. Cool. We'll move on to some listeners' questions. We've got a few to get through. And the first question is from Alozar. And he's asking us about our thoughts around enabling stock lending programs within brokers. So I think interactive brokers allow you to do this, where you allow them to take your shares, loan them out, and they pay you interest on that. What do you think of it?
And some brokers do it anyway without asking your permission. But that's why they say they keep the commissions low. I'm not a fan of it. I'm really not a fan of it. It feels like this is such a thing that will once go wrong and then remind us all that this risk was there for a reason. We haven't seen it yet, but somehow I just don't feel comfortable with it. I just want to own my shit and not have it with others.
I always get that feeling there's no such thing as a free lunch.
Exactly.
And that's my overriding feeling with this. I don't understand the risks well enough. When I read through interactive brokers, it seemed shares are safe. Even if they lent out and something goes wrong, we'll give you the money back, give you the shares back. But it just
feels, but why them lend them out in the first place?
Exactly. It just feels too good to be true. And look, they're obviously using leverage or something with this. So there has to be bigger risks. And it's, as I say in work, that's above my pay grade. So I don't want to think about it. I just want to have the shares that I own. I know what I own. I know what dividends I get from them, and I don't need anything else.
And yet, I believe with being at the hero, you anyway have the risk that some of them are lended out.
Probably, yeah. But so, I would say interactive brokers is my main broker. Manny Mystery has asked us, with a Trump presidency soon and talk of high import tariffs and a greater reliance on US manufacturing, do you think that a policy of price capping on essential services like energy and products like food could lead to growth stagnation for large US companies?
I do think so, yeah. I do think so that the tariffs will impact it. But the question is, will the local economy start thriving more? Yeah. So generally speaking, in economic theories, when you have tariffs, it disrupts the free markets, and the free market generally is seen as everyone will do better in this.
Yeah.
Because there are lower barriers to do business with each other. So taking that philosophy in place, yes, tariffs should hurt overall, but maybe maybe the chip industry starts flourishing a little bit, because of the less of the dependency on each other. I don't know. It's too much macroeconomy for me to really think about a lot. I don't spend a lot of time thinking about it.
Yeah. There's a lot of fear though about this new Trump presidency compared to the last one. Even from non-investors, I speak to people in work, and they're talking about even jobs. We work for a US multinational, for example, and people are scared. Oh, maybe they're going to take this away and it's going to move to the US. So there seems to be a lot more of that happening compared to. I know there was talks last time, but I believe Trump has more things in place.
He is on steroids now, right? He has no incentive anymore to get reelected. So
so he has whatever he has. So there's a lot of that going on, and this whole "Make America Great Again." So maybe that's part of his plan. Maybe he wants to restrict the free movement outside of America and really bluster local economies.
So whatever he does with this, as long as he remembers about my shares, I'm kind of okay.
We got a question from Mindegus, and he's asking, why do companies use buyback strategy?
I think it's really just to improve shareholder return. What you need to know is that CEOs are also shareholders. They typically have stock option plans and everything, and they may even have in their bonus targets that thou shall grow the EPS. So if the EPS, and you can grow the EPS in multiple ways, right? And one of them is of course by growing revenues. But if that's not going quick enough, you can just turn on the buyback machine. And that's why I think we see also companies like ASML just buying back shares, even if it's just a 0.3% yield at massive money because of a 40, 50 PE valuation. I think it's still just to prop up the EPS so that they easier hit their bonus targets.
Yeah.
And I guess the general philosophy is that it's that the shareholder benefits, and usually they don't have a solvency ratio or a balance sheet ratio attached to the same bonus KPIs.
I would say that's probably the main reason is in relation to bonuses and board
because
members.
Founder-led businesses, and we see that also. Just look at Evolution. They really doubled down on it when it was under 1,000 Swedish krona. And Buffett does the same. So founders seem to be more like when there's value, and the general corporate CEO, the career CEO, seems to just turn it on no matter what, even if it requires to load up debt, so that they make their bonuses. Think about Nestle as an example.
Because I was looking at Inditex this week for their newsletter, and obviously they were founder-led and they never did buybacks, but they were never trading at a level that you would consider cheap or undervalued by a wide margin, which is why they didn't do it. But you would have companies like IBM who just turn on the tap and buy shares no matter what the price is. So it's interesting.
And no matter the balance sheet.
Yes. Yuval has referred to the last episode, and he's asking, why are we not investing in communication companies, especially in these times when the sector as a whole is cheap compared to the 5-year average in price to earnings terms?
I just haven't seen any business that I'm interested in. Like, I don't like Verizon. AT&T, I burnt my hands on. Actually, I made it with a profit, but I just miscalculated the dividend safety at the time. That's it.
I feel like when people talk about diversification, they feel like they have to own every sector to be fully diversified. And if you look at the communications sector, I know there's companies that are classed as communications that don't fall into this. But generally speaking, they're CapEx heavy, they have lots of debt on their balance sheet, and they have to continuously improve their operations, particularly when you look at some of the companies we spoke about. So it's a sector as a whole that goes against what I look for in a company generally. So it's a sector I try to stay away from. I got burnt with AT&T, as I said. I had Orange for a short bit. I thought they were really undervalued at the time, but other than that, I try. It's not a sector that entices me in. I say. Medrad has asked us about tracking performance of insurance companies and what metric. Obviously, there's no silver bullet, but which metric would you prefer? Free cash flow, unlevered free cash flow, no PAT, operation cash flow, etc. Which one would you prefer?
I guess it would be more around operating cash flow, because it's probably the most cleanest around those insurance companies. But to be fair, usually what I've seen, like the NN groups of this world, is ASR, also Allianz, they use the right metrics and they also clarify why they use them, and it makes sense with what they say. Yeah, and sometimes it's just net income for some of them. I believe that you could really use for Munich RE probably the net income there. Yeah. So I would say first also read what the company is using, why they are using it, for what reason. Because for instance, if you have a large real estate portfolio, you don't want to use the net income, because every time when they need to increase the asset value, for instance, then this travels via the income statement. But also if they need to do write-offs because, I don't know, higher interest rates, it also flows via the income statement. These are all non-cash events. That's why in such a case, operational cash flow may be much easier to use, because it's a bit more neutral, because all those non-cash events get adjusted again. And I think this is important with insurance company. But then you also need to understand, like, what asset the insurance company invests in or owns, and that's a bit different among the insurance companies.
Yeah, it's like a sub-industry within the industry. And Thomas has asked us, when is oil production stalling and society collapsing?
Well, if I would only know, I would buy Bitcoin.
We should have bought Bitcoin 2 or 3 years ago. It's hitting close to 100K now. It's crazy.
Yes, we're the idiots here.
Yeah, of course.
Still talking about dividends while the others are driving Lamborghinis and buying airplanes.
Good luck staying poor. Yeah. Hugo has asked us about currency. The current euro to US is at 1.04. The euro is actually in free fall at the moment. Does this keep you in doubt when making an investment in a US stock?
No, not really, because for instance, I started investing in 2014, somewhere like that, and I believe that the euro was at 148. Yeah. Or I remember that at least one time that I was investing, it was at 148, and now it's at 1.4. So the trend is there. That's true, but where it ends up, I don't know. We had this question also a lot when it was at $1. Like, was it 2 years ago? Yeah. And then it went back to 110. But you know, it's only expensive when $1.04 if it goes back to $1.10 or 20. But if it goes to 80 cents and never doesn't come back over the next 20 years anymore, then this was a pretty cheap time to buy.
Yeah.
What you can do if you're afraid of this and you want to anchor in, you should kind of start buying or hedge yourself by taking some currency related hedges, right? Then you can hedge yourself, but that comes again at a price at your portfolio.
Yeah, it's a tough one, and the euro has been struggling since Trump has got in. I mean, the feeling is now that Europe is on its own. We're overregulated. There's no innovation apart from ASML. We have no real technology powerhouses. So it's under a lot of pressure, but again, that's all macro, and that can change in an instant.
Yeah.
So for me, I just continue to dollar cost average, and I don't even look at the prices of that. So
well, I see it, right, and I totally understand the feeling. Like, I'm buying now at almost $1, you know, because I'm price anchored at 110 or 112. I see my portfolio value going up, probably because I have quite some dollars in there, right?
Yeah.
So, and it may give me the illusion that, well, my portfolio is going up and everything, but can also go massively down again. If it goes back to 120, my portfolio will be hit hard. Yeah. Even it will cost me dividend income.
Yeah.
So it is a fact of life. That's why dollar cost averaging, in my opinion, is a good answer to this.
It's the only tool in our arsenal that we can use, other than buying dollars.
Yeah, and starting to hedge, for instance, with those leveraged products is not something that I'm a big fan of. Why give in yield and return? To do that for something that could protect my portfolio, of course, but I wonder if the accumulation of buying protection isn't more expensive than the once in a decade or 20 years when I need that protection.
Hugo's asked a second question around the importance of a pension plan program when analyzing a balance sheet of a company. And I always go back to UPS. Is it UPS? Yes, UPS, when you speak about this.
Yeah, and that's why I don't buy UPS. I think IBM had it as well, right? In one of the latest quarterly earnings reports, also again a few billion. They travel via the income statement, and in the case of UPS, it's just too much for me. Because it adds up to the debt pile that it has, and then it's just too much for me. And then because oftentimes when you calculate the debt to equity, it doesn't take pension liabilities into consideration. The same as that most data providers, they don't look at lease liabilities, and there are companies like Ahold that have limited long-term debt but massive lease liabilities. And I also consider that long-term debt because it needs to be paid somehow in the future, right? Pension as well. So because they could have as well just pay some pension, but they also need to make reservations for this. So it is a future obligation that the company has, and it will eat from the cash flow. And what you see sometimes company doing, they are just handing over this part to another provider that will then deal with it. But this will again have an impact on the book value of a company. So it's all connected, and that's one of the reasons why I don't like companies with really large pension liabilities, specifically compared to the equity.
El Cuba has asked our thoughts on Procter and Gamble. It's growing and growing, and is it on your buy list?
No, not really. I've got already Unilever. I would argue Procter and Gamble has done better over the last 10 years, but maybe now with the new CEO, it's Unilever's time. Let's see.
Yeah. I was thinking that Unilever is probably where Procter and Gamble was 10 years. Was it 10 years ago, before you had these investors come in? And the same investors have come into Unilever. So it's I sold my Unilever position, but I really hope it gets back to some growth. And to answer your question, no, they're not on my list. Mac has asked us about Games Workshop. Not really asked us about it, but he's saying that the trading update after 6 months, revenue was up 16%. Profit before tax is up 25% nearly. So please do a deeper dive on this business. And you've always flirted with talking about this company, but I don't know if you've ever dug into them.
I always flirted because after that I look at the dividend history and it's not stable.
Yeah, and I think that's probably the killer with the company, but it's must be worth looking at. It
has not demonstrated that it pays a safe dividend, even though the company could. They don't.
Yeah, shareholder commitment is not there. JC has asked us about PepsiCo at these prices. Do you think the nomination of Kennedy Jr. will have an impact on sugar snacks compared to healthcare companies?
Potentially, yes. My thoughts specifically about PepsiCo is that they have too much debt, but that's kind of normal for such a company, but their payout ratio is too high, and that's what doesn't make me feel comfortable. Just anything needs to happen to the EPS and the sustainability of it, and maybe then it will have a really hard time to justify paying a growing dividend. So I have a feeling that they're walking a little bit along the lines of an edge here with PepsiCo. I do own a few shares, and actually someone asked me on Twitter, like, so if you have these doubts, why do you still own them? And I actually was thinking about that during the week, but not too much. So I still need to get back to that because it was an interesting question.
Yeah. Yeah, we get challenged on this company. I would say it's one of the most challenged companies we get because I don't have as much conviction in PepsiCo. But a lot of investors clearly do. I mean, it has the brand
Yeah.
power. It's more diversified than Coca-Cola, for example. And yeah, I just don't have that conviction in them. So for me, I I stay away from them. But can the sugar snacks? Yeah, I mean, sugar taxes can impact the company, but I'm sure the company will pivot. They'll have low sugar options. They
Yeah.
can manage it that way. So the long term trajectory, I wouldn't be concerned because of one person going into power. But short term, yeah, it can have.
And if America gets a healthier society, my portfolio should also benefit a bit. So
Yeah, but you can't change consumer habits overnight either. He's not just going to come in, put in a tax, and
yeah.
people are going to stop buying PepsiCo. That's not going to happen.
Yeah.
People will still buy, so it'll be a gradual thing, in my opinion. Daniel has wanted to comment on Glambia or Optimum Nutrition, a brand that takes a lot of shelf space in Poland. Is Go On, Goon. It's owned by a different company, but he's seen them in a lot of other countries. So it looks like Glambia has fierce competition in this area, and the cost of switching is low. And I think so. I think we mentioned that with Glambia. It is $1 billion brand, but if I look at my own preferences, there's no consumer loyalty there. And that's the thing with protein. It is a fiercely competitive industry. But I mean, it is $1 billion brand for a reason. They've done
Yeah,
it.
exactly.
Jan has asked if you've ever looked into Mondelez in comparison to someone like Hershey's.
Yeah, definitely. And Modellus is also a good company. I always have preferred Hershey a little bit because of the Hershey
Foundation.
fund. Yeah, foundation behind it, and our incentives are very much aligned. Sometimes you have that with a company. It's not like one is necessarily very much better than the other, but you just have a better feeling with one or the other, and that's the case here.
Yeah, I remember that graphic. I think you shared it a couple of years ago, but all the companies that own the major brands, you had Mondelez, you had Unilever, you had Hershey's, Nestle, obviously, of course. All you have to do is own a little bit of each, and you have the whole world covered.
Exactly.
Alex has asked us about our thoughts on Google spinning off Chrome.
That's a very interesting one, right? And this comes from the US, I believe.
Yeah.
Also very interesting because they're always saying that the EU is trying to kill American companies. Yeah. So for me, this is very interesting that also America has the same anti-competition laws, but somehow when it's European Union asking this, it's bad. Yeah. But when it's America asking about it, then it's, I guess, okay. I mean, so I own a few shares of Google as a disclaimer. I think splitting Chrome could be hurting it because what may happen then as a result is that Google would need to pay Chrome for being the standard browser and the default browser.
Yeah.
So that's where I think there could be an issue for Google. Because still most of it earnings come from the ad space here and using Google Ads.
Yeah.
But I mean, let's see what happens.
Yeah. It feels like it's prime time for some disruption to happen in the browsing space. I mean, Google they own what 97% of market share.
Yeah.
It's crazy. I mean,
but I really wonder if Google is well positioned for the future when it comes to AI generated search. Things about Perplexity AI now.
Yeah.
I get this feeling, and maybe I may be proven wrong in a year from now, but I get a little bit this feeling as Google challenging Alta Vista. I have a bit this feeling with Perplexity challenging Google.
Yeah.
I'm so curious about what will happen in this space. Also with Copilot and Bing, I'm really curious about whether Google. I mean, we are kids of Google, right? Our young adulthood was formed around Google. Our education was like, I'll Google it.
Yeah.
I'm wondering if this is still the case 10, 15 years from now, because these modes that Google have, they are only a mode. so far as a moat is needed. Yeah, I made one time the comparison like, well, castle moats were really useful until cannons were invented. Yeah, because then you could just blow up the wall and you didn't need any more ladder to climb over it, and they will push you off. Yeah, and that's the same here, right? Maybe this will change something. Maybe I don't know, maybe at a certain moment Google Chrome may feel outdated, or like my son says, like, oh, I would like to be on social media. Oh, join me on Facebook. No, that's for grandparents. Yeah. So Google needs to wake up again and fight hard now. The competition is on, knife is on the throat, and I will be eating popcorn.
Yeah, the competition is on, but they're so far ahead that they have time.
They have the money.
Yeah,
they have the money. That's a good thing.
I don't know if you've seen, I think it was a YouTube short or maybe Instagram around this news, and they had 3 people sitting around but pretending that they're the businesses. So you had Google, you had Bing, and you had Yahoo there, and then you had the DOJ person asking questions like, how much of the market share have you got? And Yahoo's like, I've got 2%, and Bing had like 7%, and Google obviously had 92 or 91%. It's like, what are we going to do about this? We're like, I don't know. So your man DOJ goes on to the website and Googles how to take Google's market share, and they're like, you're using Google to Google how to make this more competitive. Quite funny.
Yeah.
Anyway, I think that answers Jean Crostavy's question around the news as well. Eric Mead has asked about Unilever trying to unload its ice cream business, and we know they're trying to do this for over a year now, but there are no buyers. And is that because of Ben & Jerry's outspoken management? Should they just be fired?
I believe they can't fire management because they had this whole issue with Israel the other day, like 2 years ago or 1 year ago. And Unilever could do nothing because Unilever is the owner, but they have an agreement with Ben & Jerry's that kind of Ben & Jerry's has the sole, the sole freedom to do whatever it needs to do. That was part of the buying decision. And this may be a reason why it's hard to sell them. True.
Yeah, it is dragging on a bit. Like, they've spoke about this for a while now, and that management, as you know, is outspoken. So yeah, I think it is hurting them. But on the other side of it, the ice cream business had a lot of growth in the last quarter.
Exactly. So it should be a bit worth more now.
Yeah. And the last question goes to Philippe, and he's asking us about Dollar General. Seems they are causing some trouble to Realty Income at the moment. How do you see it playing out long term?
Yeah, I don't really have an answer to this question. I understand where it comes from. It's, I believe, a discount store, one of the largest tenants of Realty Income, which therefore may put things at risk. If you look at the diversification of Realty Income, I'm really not so concerned, and it's never that a full tenant income will disappear, because then they will find probably for some of the buildings a new tenant or whatever it may be. So it's never like 100% drop straight away to the amount of the let's say the share of the tenant in the portfolio.
Yeah. I mean, this comes off the back of Walgreens, which was a troublesome tenant for Realty Income.
Yeah.
If you want better investment grade tenants, look at Agree Realty.
Yeah, exactly.
Nice one. That's the end of the show. Thanks to everyone for all their questions, and thanks as always, European DJI, and we will see you all next week. Remember, both of us at Dividend Talk are not certified financial specialists through formal education. We are just 2 guys sharing our journey for inspiration and entertainment purposes. Hence, this is not investment advice. Although we do our best, we can't promise that the information discussed is always correct, nor appropriate for you or anybody else. We always recommend that you do your own due diligence and be accountable for your own choices. As we always say, you can't borrow conviction from others. Last but not least, by listening to our podcast, you agree to hold us harmless from any ramifications, financial or otherwise, that occur to you as a result of acting on information provided in this podcast.